How to answer capital investment decision questions. First step is to calculate the accounting rate of return. To calculate the accounting rate of return, you need the average annual profit and the average investment. And to get these, you first need to calculate the average operating cash flow and the annual depreciation. Annual depreciation is equal to the initial investment, which is given in the question, 800,000 minus the scrap value, which is also given in the question, 100,000 divided by the number of useful years. We see 1, 2, 3, 4, so divided by 4 years, and that should give us 175,000. Average operating cash flow is equal to the sum of cash flows, so just all of these added together, so 300k plus 320k plus 300k plus 260k, and then again divided by 4 years, divided by years, 1, 2, 3, 4. Average annual profit is just simply this minus this, average operating cash flow minus annual depreciation. So average operating cash flow is 295,000, annual depreciation is 175,000. So 295,000 minus 175,000 is equal to 120,000. So average annual profit 120,000. Average investment is equal to initial investment plus scrap value. Again, initial investment is over here, 800,000 plus the scrap value, again given in the question, and then always divided by 2, which would give us 450,000. So now we have all the components we need to calculate the accounting rate of return, which is average annual profit divided by average investment. Well, our average annual profit is 120,000 from this part, divided by our average investment 450,000 from this part. That gives us an average accounting rate of return of 26.7%. It's always expressed as a percent, so whatever number you get in your calculator, express it as a percentage. So basically times this by 100. WDA schedule should have the number of years plus year 0. Year 0 is the first thing to be filled in. It's 800,000, which is the initial investment. So year 0, WDA is blank, WDV is the initial investment of 800,000. And then to calculate the first WDA in year 1, we do 800,000 times whatever the rate is. Here is 25%, as we see in the question. Here is 25%, so 800,000 times 25% gives us 200,000. Then we calculate the next written down value, which is simply this minus this, which is this. So 800,000 minus 200,000 is 600,000, and the same again, 600,000 minus 150,000 is 450,000, 450,000 minus 100, and 12,500 is 337,500, 337,500 minus 84,375 is 253,125, excuse me. And then that is the number we use in when calculating the balancing allowance or charge. To calculate the balancing allowance or charge, you have to look at, is the scrap value higher or lower than the WDV? If the scrap value is lower than the WDV, then you do WDV minus scrap, and that is a less balancing allowance. So if scrap is lower than WDV, it's a balancing allowance. If scrap is higher than WDV, it's add a balancing gain. And the equation is if WDV is higher, it's WDV minus scrap. If scrap is higher, it's scrap minus WDV. Basically, you always subtract the smaller number from the larger number, either way. It's because look, scrap is bigger here, so it's scrap minus WDV. WDV is higher here, and it's WDV minus scrap. So bigger number minus lower number, bigger number minus lower number. We have to really remember is if WDV is higher than scrap, it's a balancing allowance. If WDV is lower than scrap, it's a balancing gain. And that balancing gain, if we plug it into the equation, in this case WDV is higher than scrap, so we do WDV minus scrap, which is 100,000, which is 253,125, which is our WDV from here. We take our WDV from here, 253,125 minus 100,000, which is the scrap, again given in the question, gives us 153,125. Now we move on to step 3, which is the tax schedule. Now moving on to step 3, the tax schedule. On the left we have operating cash flow less WDA, less balancing allowance, or add balancing gain, taxable profit, tax. Then we have the years 1, 2, 3, 4, no year 0, no year 5, nothing like that, just years 1 to 4. Okay, so the operating cash flow, 300,000, we get from the question. Less WDA for year 1. We go to our step 2 WDA schedule. We see the WDA for year 1 is 200,000, so we write 200,000. Less WDA for year 2, 150,000. Year 3, 112,000. Year 4, 84,375. Then our balancing allowance or gain, it's always put in the last year. The column is the last year. So here our last year is year 4, so it sits in year 4, 153,125, and it's a less balancing allowance because the scrap was less than the WDV, aka the WDV was higher than the scrap, and then so we know that this is a balancing allowance, less balancing allowance, when the WDV is higher than the scrap. Then taxable profit is simply the sum of these. So 300,000 minus 200,000 is 100,000. Sum of these, 320,000 minus 150,000, 170,000. Sum of these, 300,000 minus 112,500, 187,500. Sum of these, 260,000 minus 84,375. Then minus our balancing allowance, 153,125, gives you 22,500. Then we calculate the tax on the taxable profit. Our tax rate is 25%, as it says here. Corporation tax is 25%. So 100,000 times 25%, 25,000. 170,000 times 25%, 42,500. 187,500 times 25%, 46,875. 22,500 times 25%, 5,625. Then we move on to step 4, cash flows and MPV, and we take our tax figure with us. We will be using that in here. And on the left column you have investment, scrap, operating cash flow and tax, and then net cash flow. Then we'll move on to these in a minute. So investment, in the top, you need to have year 0, year 1, year 2, year 3, year 4, and year 5, because tax is paid 1 year in arrears, which means year 1 tax is paid in year 2, year 2 tax is paid in year 3, etc. So once you get to year 4 and you're paying tax, you don't actually pay that tax until the next year. So we have to create year 5 because year 4's tax is paid the next year in year 5. Okay, so left, investment, only one to fill in here. It's just the 800,000 initial investment. Then we have scrap, again from the question. Scrap, it has a 4-year life, so we put it in year 4. Operating cash flow, it's just from the question once again. These. Tax 1 year in arrears we get from the calculation we just did over here. So as I said, year 1 tax will be paid in year 2. As we see, year 1 tax is 25,000. It's paid in year 2, 25,000. So we pay nothing in year 1 because we obviously were taxed nothing in year 0. So that's how that works. And don't forget the tax in year 5, because we pay year 4's tax in year 5 because it's 1 year in arrears. And then we just sum all of these up and we get the net cash flow. So year 0, 800,000, negative 800,000, year 1, positive 300,000, year 2, positive 295,000, year 3, positive 257,500, year 4, 330,125, and then year 5, negative 5,625 because of that year 4 tax that's paid in year 5. And then we have the PVF at 10%. This is given in the question as cost of capital. So when you see cost of capital, this is the percent you have to apply here. As you see here, 10%. So we use this figure in the present value table. Present value figure at 10%, 10%, year 1, 0.909, year 2, 0.826, etc., etc. Just consult the table they give you. So then to find the present value of each year, starting with year 0 is always year 1. Year 0 is the PVF is always just 1.0. So year 0 PVF is just 1. So it's 800,000, negative 800,000 times 1 itself, it's obviously going to be 800,000. Year 2 we have 300,000 in net cash flow, 300,000, so 300,000 times 0.909 gives us 272,700. 295,000 times 0.826 gives us 243,670, etc., etc. And you just do that for all of the following, times this by this, this by this, this by this, and you get these from the table. And you know what percent to use because it tells you in the question in terms of cost of capital. Cost of capital, 10%. And then that will give us the present value of each year. Then to find the net present value, we simply add up all the present values, which gives us a net present value of 120,124. Now we move on to the payback period, which uses the net cash flows from step 4, uses these figures. We don't know how far. We start with, on the left, the years 0, starting at 0, 1, 2, 3, 4, and you can carry on as much as you need, but obviously it can't go beyond 5 in this situation. So the net cash flow for year 0 is 800,000 because that's the initial investment. 800,000 flows out of the business, and year 0 is the initial investment. And then we have the cumulative on the right, so 800,000 so far is accumulated. And then year 1 net cash flow, if we look back at how net cash flow we calculated over here, is 300,000. 300,000. So that would be 800,000 minus 300,000 gives us 500,000. And then net cash flow for year 3 is 295,000. So it'd be 500,000 minus 295,000 gives us 205,000. 205,000. Year 3's net cash flow is 257,500. And then the cumulative, this is the important part, the cumulative cash flow now becomes positive. So this is the year we know we make some money back, but we don't know how far into year 3 we actually become positive. So it'll be 2-point-something years because we know it's sometime into year 3. It could be 2.99909 years, which would basically be year 3. But to calculate that, we need to divide the year 2 cumulative amount, which is 205,000, divided by 257,500, which gives us 0.796 years. So 2 years, because it's 2, and then 0.796 years into the third year, which gives us 2.796 years, or just round it up to 2.8 years. So to find the fraction of years, because you already know it's at least 2, you just divide this by this. The figure above, the cumulative figure above where it becomes positive, divided by the net cash flow, and the line it becomes positive. Step 6, IRR, is basically just you have to learn an equation, which is kind of annoying, but there you go. Basically what you're trying to find is our cost of capital that we used gave us a positive net present value, as we see here, 120,124. And IRR wants you to find another discount rate that makes the NPV negative. So you want to somehow come to a negative NPV, and you need to find a discount rate that does that. So we know that 10% gave us a positive net present value. So we know we need to use a higher cost of capital to make the NPV negative. Let's go with 20%, and there's no penalty for going too high. Just make sure, as long as it produces a negative NPV. And as you see in the table, for calculating the NPV at the new rate we've chosen, which is 20%, it's the new higher rate we've chosen to try and produce a negative net present value. We have the year, the net cash flow from here, the PVF at 20%, the new rate, so year 0 would be 1 as always. Then let's consult the table. 20% will be 0.833 for year 1, 0.694 for year 2, 0.579 for year 3. Yep. And then it's this times this is equal to this. This is the present value. This times this is equal to this. 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 Then you add them all up. These are all the present values for each year. And you find the net present value at the new rate, which is now negative, which is what we want, which is 47,612. Then what we do is we have to use this formula, where the IRR is equal to L plus NL over NL minus NH times H minus L in parentheses. So IRR is equal to the lower discount rate, which is the one we used from the question, which is 10%. So 10% plus NL is equal to NPV at the lower rate. NPV at the lower rate, which was 10% we found earlier, which was 120,124. So 120,124 over NL, we just did that, 120,124 minus NH, which is the NPV at the higher discount rate, which we just calculated, which is negative 46,612. So minus negative 47,612, and then times by, all in brackets, H minus L, which is just the higher discount rate minus the lower discount rate. So in this case, it's 20% minus 10%, so that gives us 10%. And then once you have this part, just plug it into a calculator and you'll get the result. It's as simple as that.